speaker is Simon Thompson, virtually from United Kingdom. Simon is the CEO at the Chartered Banking Institute, and he's going to talk about the banking profession in the ESG era. Banking, without a doubt, is an industry that's been transforming over the last couple of years due to the extensive regulation from the European Union, but also from the recommendations of the European Central Bank, the guidelines of the European Banking Authority, and market practice. So I give the floor now to Simon. Simon, can you hear us?
I'm not virtual, I am real. It's just that I'm joining
Simon?
you from home here in Scotland today. I hope you can hear me okay. Great, well, let's carry on then. So yeah, although I'm here in Scotland, in some ways it's quite appropriate because we have COP26 now just a month away, which takes place only a few miles actually from where I live. So I think it's quite appropriate for me to be speaking with you this morning about banking and sustainability, and in particular about how we can align banking and finance with the objectives of the Paris Agreement and sustainability more broadly. So here's some of the things I'm going to try and cover this morning. As Michael mentioned, I'm the Chief Executive of the Chartered Banking Institute, but I'm also an author in this area too, and lead our institute's work on green and sustainable finance. So I'll spend about 20 minutes or so sharing my reflections on where we are now in terms of aligning finance with sustainability, what will come next, and in particular, how we can develop and sustain cultures where, to take Mark Carney's words, every professional financial decision takes account of climate change. Where we are now in terms of aligning finance with sustainability. So, first of all, let's ask ourselves the question, are we actually in the ESG era? Now, Michael, you asked me to speak on the subject of the banking profession in the ESG era, which seemed to imply that perhaps this is an era we are already part of. And it's maybe easy when people meet at events like a sustainability forum to think that we are. Everybody seems to be talking about ESG and sustainability, and there has undoubtedly been very rapid growth in the sector in recent years. But let's remember that green bond issuance is still only a very small proportion of total bond issuance. Green and sustainable corporate lending may be growing quickly, but again is a very small proportion of overall lending. There's a lot more talk than action there. Green mortgages are still a very, very small proportion of the overall mortgage market. We may see a lot of institutions signing up to alliances like the Principles for Responsible Banking and the Glasgow Financial Alliance for Net Zero. Sometimes hundreds, but there are thousands and thousands of banks that are not members of these. And when we look at the investment sector, while more than a third of total global assets under management are now described and labeled as ESG or sustainable, are we really certain that these are genuinely the case just because they're labeled that way? In fact, a large proportion probably are not aligned with the objectives of Paris and wider sustainability goals. For me, the key data point in all of this is that globally, financial institutions' lending and investment portfolios are at the moment aligned with considerably more than 3 degrees of global warming at present. So our world is still built on an economic model powered by fossil fuels, and we still finance it on that basis. That needs to change, and it needs to change quickly. The IPCC's August report showed that without urgent, dramatic and sustained action, we will certainly exceed the target of maintaining global warming to as close to 1.5 degrees above pre-industrial levels as possible. And in fact, we may well exceed 2 degrees of warming later this century too. So I contend we're not really in the ESG era at all yet, except in the sense that we spend a lot of time talking about it. And it's time now to stop talking and to align banking and finance with the objectives of Paris, with the UN Sustainable Development Goals, and with sustainability more broadly, so that green and sustainable finance moves from a rapidly growing niche to become the mainstream of finance. And ESG moves from being an example of best practice to becoming standard practice throughout banking and finance. So let's think about how we get there. How do we transform banking and finance so that we lead and support a global transition to net zero and sustainability more broadly and not detract from it? Now, our roadmap for banking and finance is set out, at least in terms of addressing climate change, which I think most would agree is the greatest global challenge and our sustainability priority, in the Paris Agreement and in the COP26 private finance strategy. But the Paris Agreement on climate change has three objectives. The first is widely known: to limit global warming. The second objective is also fairly widely known: to promote climate resilient development. But the third Paris Agreement objective is less well known, and yet it's critical to achieving the first two objectives. Article 2.1c requires countries to make flows of finance consistent with low greenhouse gas emissions and climate resilient development. And I think it's very telling that the key global climate change agreement singles out the critical role of finance. And as countries adopt statutory and binding net zero targets, banking, investment, insurance, accounting, all of finance will be expected and will be required to play a leading role in the transition of energy, transport, agriculture, buildings, production, consumption, in fact, every economic activity, every economic entity, to more sustainable, low or zero carbon models. And the system-wide impacts, costs, risks, and of course the opportunities of that transition are not yet understood or priced as they should be within finance, let alone within banking, within business and society more widely. But they are very much exercising central banks, financial regulators, and so on, because of the implications for prudential regulation and financial stability overall. And they are increasingly being built into financial institution strategies, activities, and operations as more and more institutions, although still a minority, seek to align these with the Paris Agreement and with wider sustainability goals. In financial services, the recently launched Glasgow Financial Alliance, GFANZ, which I mentioned earlier, brings together more than 160 firms with assets under management of more than $70 trillion now. They've all set science-based targets to reach net zero by mid-century, but importantly, with ambitious 2030 interim targets as the first major milestone. That's only 9 years away now. And that financial alliance is chaired by Mark Carney, now the UN Special Envoy for Climate Finance, formerly the Governor of the Bank of England. Last year, he published the COP26 private finance strategy, which sets out the roadmap for financial institutions, such as the members of the alliance, but the finance sector more broadly, to align with the objectives of the Paris Agreement. And it does this through 3 R's: reporting, risk, returns, plus 1 M called mobilization. So let's look at each of these in turn now, beginning with reporting, as this takes us into what an era of ESG might look like. The reporting and disclosure are seen as key to aligning banking and business in general with sustainability, because without credible, consistent and comparable reporting of emissions and other sustainable impacts, both positive and negative, we can't measure the alignment of lending and investment portfolios with the objectives of Paris and other sustainable goals, which is why we're seeing new demands from regulators, investors and others for better climate risk disclosures, for stress testing, for scenario analysis, and for disclosure and reporting on social issues too, including aspects such as equality, diversity, and fair work. Now, I'm afraid we're not, in my view, going to see a single approach to reporting and disclosure, but then we don't see this in other areas of banking. What we will see, and we are already seeing emerge, though, is a harmonization and convergence of reporting and regulatory approaches more generally. So let me give you 3 examples of that. Firstly, around disclosure, where TCFD is becoming the de facto approach. The UK is leading the way in mandating TCFD aligned disclosures from 2022 onwards, but this is being followed elsewhere now, particularly, as many of you will be aware, in the EU. And it'll certainly be interesting to see to what extent broader environmental disclosures to be developed by the new Task Force on Nature-related Financial Disclosures, the TNFD, will be adopted in due course. They're due to report in 2023. Secondly, with enhanced cooperation through the Network for Greening the Financial System, the NGFS, now encompassing more than 80 central banks and financial regulators, I think we will see some significant harmonization of approaches to micro and macro prudential regulation and supervision, in particular more consistent approaches to stress testing and scenario analysis for financial institutions. Back in April this year, the NGFS published proposals for the harmonization of central bank approaches to green asset purchases and climate-related lending schemes. And although it's a highly political area, I would expect to see convergence of thought, if maybe not action, for some time around capital requirements and green supporting factors too. Of course, the European Banking Authority's green assets ratio approach starts to tilt the European regulator in this direction. And then thirdly, moves to standardized non-financial sustainability reporting through the IFRS Foundation's proposed new Sustainability Standards Board, especially around how we can account for Scope 3 financed emissions, which ultimately we need to be able to do to measure and track progress towards Paris in a comparable, consistent manner and use as a basis for good business, good lending decision making. I don't think we will have by any means a single set of disclosure requirements and standards for sustainability reporting, not least because the IFRS is at the start of a very long journey. As with financial reporting standards, will the US and China really adopt these? Probably not. They haven't adopted IFRS, for instance. But reporting will converge, but it will take a lot longer than we'd like. And there will, I'm afraid, be some unhelpful duplication and overlap along the way, but that's true in many other sectors too. So now let's turn and have a quick look at risk. The implications of more than 2 degrees of warming or of a disorderly transition are extremely worrying and come with very significant human and financial costs, which are only going to increase. Many countries and communities are extremely vulnerable to the physical effects of climate change, especially rising surface temperatures, water shortages, increased frequency and severity of severe weather. In Southern Europe, where you are, you've experienced the effects of drought and wildfires this year, and in many previous years, of course. And this summer, other parts of Europe, Northern Europe, were badly affected by very severe floods. And of course, this is devastating for individuals and communities, but it's also disastrous for lenders and investors exposed to physical risks, whether through commercial and residential property exposures or through the impacts on business revenues and costs of disruption to supply and distribution chains. There's increased costs too of making production facilities, properties and supply chains more resilient to the impacts of climate change. And in extremis, we have the impairment or standing of physical assets if climate change make them uninhabitable or unusable, and this does happen. There's another side to this, and that's the implications of the net zero transition and transition risks, including policy and regulation, changing customer sentiment and demand, and clean technology replacing older, dirtier alternatives. I can't stress the importance of transition risks for most sectors and firms and our global financial system enough. For some sectors and firms, the implications are existential unless they radically transform their business models. Think about Kodak and Blockbuster Video, a decade or more ago, and now in terms of climate, think about coal mining associated firms. And think of the implications for investors and lenders if they're highly exposed to a firm or a sector that in 10 years' time might no longer exist. Now, I personally don't think the implications of transition and asset stranding from transition, the risks of that are understood across financial services in the way they should be. If they were, then we would be in the era of ESG. We also need to understand, I think, that every future scenario we face includes greater physical or transition risks, or a combination. If we fail to tackle global warming, then the physical impacts and associated financial impacts continue to rise. Achieving net zero by 2050 will moderate the climate hazards, but that implies very substantial transition risks and their financial implications, which is why, from an economic and financial stability perspective, central banks and regulators have become increasingly concerned about climate risks and broader environmental risks in recent years, and why every business leader, every business owner, every financier needs to try to identify, measure, and manage climate and environmental risks too, because these need to be understood as significant cross-cutting risks that are already and will continue to have substantial impacts on lending and investment portfolios. But where there are risks, there are, of course, also returns. That's the business we're in, right? And if we are to align banking and finance with sustainability, it is the carrot of commercial returns that will help to drive this, rather than just the stick of regulation, reporting, or risk. Now, here's the good news. We know what we need to do to tackle the climate challenge in terms of the mitigation adaptation measures required. We have the technology we need to do that, to transition to net zero by 2050, although many need to be substantially scaled up. We know how much it will cost, approximately $6 trillion per year, according to the G20, and we have the capital required, held in savings balances around the world. So all we have to do at one level is make sure our banking and financial services sector does what we do best. That's transform the savings into the investments required in the sustainable technologies and infrastructure, and to help the transition of existing high carbon business models to sustainable alternatives. And whatever the precise costs of that transition, the scale of investment required means that some 80% of the funds will need to come from private finance. And that's just to finance the exciting new clean technologies and infrastructure. Bigger still are the transition finance opportunities. Now, time doesn't permit me to look at where all these are in detail, but transition finance in the shape of sustainability-linked loans and transition bonds are just two examples of instruments we're going to see grow quickly in future years that help organizations, small and large, move from high to low carbon business models. On the retail banking side, green mortgages and green retrofit mortgages are in the pipeline, the latter crucial here in the UK in terms of both residential and commercial property, given the poor energy efficiency of our housing stock. The point I make is these financial products are not difficult or complex or really all that novel. They're all examples of existing financial products with an added sustainability flavor. We're not trying to completely reinvent the wheel here. A green bond is financially identical to a vanilla bond. The difference comes in the use of proceeds and impact reporting. A green loan is a loan that simply seeks an environmental return as well as a financial return for the lender. And so by doing what we do best as a sector, connecting savings with investment and helping customers manage risk, banks and bankers really can help save the world and ensure a just transition. However, aligning banking with sustainability and doing this rapidly enough to keep global warming as close to 1.5 degrees as possible is challenging in practice for a number of reasons, including these that I've set out on the slide. Now, some of these I know will have been addressed or will be addressed in other sessions today. So I'd like to focus in the final part of my presentation on the final challenge here and hope point us towards some solutions. So how do we build the capacity and capability we need, and how do we turn best practice into standard practice across financial services? Part of the answer lies in appropriate governance, leadership, and aligning incentives with these goals, but most of the answer, I believe, lies in the upskilling and reskilling in education and training, which is our core activity here at the Chartered Banker Institute. And I think we've got some strong views to share on this. Now, in the specific context of the transition to net zero, Mark Carney, as I mentioned earlier, has called in the COP26 private finance strategy for every professional financial decision to take climate change into account. And to pass what I call the Carney test, if every professional financial decision is to include climate change, then every finance professional needs to develop their knowledge and understanding of climate change, green finance, and sustainability to the extent relevant to their role and organization. In other words, to mainstream green and sustainable finance, we have to mainstream green and sustainable finance knowledge and skills too, to turn best practice into standard practice, which implies upskilling and reskilling not just small teams of ESG and sustainability specialists, but all bankers. Because what we need is all bankers using their professional knowledge and skill of banking, of credit and lending, of investment, of risk management, to transform savings into investments in the firm's technologies and projects that generate sustainable environmental and social returns alongside financial ones. And when we get to that point, we will be in a new era of ESG in banking. But it does mean that all bankers everywhere need to develop their knowledge of green and sustainable finance so that what is currently thought of as best practice becomes standard practice, the new professional norms that banking and finance are built on. Which is where we come in at the Chartered Banker Institute and our colleagues and partners, including Michael and our friends at Global Sustain, because that's what we do. We bring together the core banking skills with the knowledge of green and sustainable finance needed. In our case, we do this through the Global Benchmark Certificate in Green and Sustainable Finance, which is available in more than 40 countries. We have a new certificate in climate risk. And on the screen, you'll see our new Centre for Responsible Banking, which brings together not just qualifications, but all our learning CPD, our thought leadership to support our members and others around the world, help them and develop their knowledge and skills in this crucial area. It's a priority for me and all of us at the Chartered Banker Institute, because aligning banking with sustainability is the future of banking. ESG is the future of banking, but it is a future that depends on us dramatically increasing our capacities and capabilities so that a culture based on green and sustainable finance and ESG is developed and sustained throughout banking. Thank you very much.
Thank you very much, Simon, for taking the time this morning to address our Sustainability Forum. I greatly appreciate your input. Would you mind sharing a few more details on the Green and Sustainable Finance Certificate? I had the pleasure and honor of taking the exam myself, and I know that's been, it's going to be very helpful for anyone in the banking industry now as we're trying to do some capacity building and training in the industry.
Yeah, well, Michael, you're being very modest. You passed the exam very well, I seem to remember. So, so congratulations. And as far as we're aware, you're our first graduate for the certificate in green and sustainable finance in Greece and Cyprus. So I think I can't see the room, but everyone should give Michael a round of applause, I think.
We're also taking some efforts with the Chartered Banking Institute to promote this certification in other parts of the world. We've done a program in Egypt, now we're planning a program in Greece, but feel free to share a few more details about the program, Simon.
Yeah, so briefly then, it's the certificate in green and sustainable finance is the global benchmark qualification. As I mentioned in my presentation, it's now available in some 40 countries worldwide, and it's intended as a foundation program to give all bankers, investors, investment managers, insurers, the basics of green and sustainable finance. But when I say the basics, there's quite a lot there because it is a big subject. So it covers areas such as such as climate science itself, because without a knowledge of climate science and how the world is changing and how the impacts of climate impact on banking, finance and business, and in turn how banking, finance and business impact on climate, the rest doesn't really make sense. It looks at climate and environmental risks. It looks at the range of products and services across banking, investment and insurance. We look at sustainable fintech as well. And we also very crucially look at the role of the individuals. So it's available worldwide. It's an online e-learning program. Exams and assessments are available in more than 5,000 centres around the world and via remote invigilation, which means people can take it at home. And very excitingly, we're about to launch the most recent version, because we have to update it every year because it's such a rapidly growing topic. The new version is actually released next Friday.
Great. Here's a question for you. There's a joke in the banking industry. It says, what's the fastest thing moving on Earth today? An airplane, a cheetah, or the speed of light? And there are people becoming specialists in ESG. What makes a good ESG specialist, based on your opinion and experience, Simon?
Well, we don't need ESG specialists in the long term, I would say. They play a very, and that's a slightly controversial statement, but the reality is, at the moment, all financial institutions and many businesses are working hard to try and build central sustainability and ESG teams. It's certainly in the UK, we can see salaries rising very quickly in that area, which reflects shortage of supply and the scale of demand. But it's not enough. I mean, we could increase the number of sustainability and ESG specialists tenfold, and we're still not really moving the dial, because we have to move from this idea that ESG is a specialism that some people do to it becoming standard practice throughout banking and finance, where every banker, where every insurer, where every investment manager has a knowledge of ESG, of sustainability. So I would say that should encompass climate, environment and social sustainability, plus economic sustainability factors too. And that is embedded as part of everybody's daily practice within finance. It's about fundamentally building the capacity, the capability, and the culture within banking and finance so that everybody deploys ESG and sustainability as part of their role.
Interesting. Good approach. Last thing before we let you go. I don't know if you've been here since the morning, but there's a lot of regulation going on in EU. You know, the ECB, the EBAs are all issuing recommendations, you know. And what's happening in the UK? I know you're not part of EU anymore due to Brexit. Are you catching up? Are you ahead with regulations on ESG? Are you paying attention to what the EU is doing?
Yeah, well, what we're seeing is and I sort of referenced this in an early part of my presentation, I think, is the harmonization and convergence of regulatory approaches, if not regulation overall. So in some areas, for instance, in terms of TCFD reporting or mandatory TCFD reporting, the UK is taking the lead. In other areas, for instance, looking at I mentioned the EBA's green assets ratio, for instance, I think it'd be fair to say some of the European supervisory authorities are taking the lead. But when we look at the sort of broad direction of travel, and I suppose the other area, most obviously where the EU takes the lead is in terms of the sustainable finance taxonomy. So the UK is developing its own at the moment, because we're not part of the EU. I don't think it's going to be dramatically different to the EU one. There'll be some little changes around the edges, I would have thought. But broadly speaking, the regulators in the UK, the EU, and I'd also say look at some other big green and sustainable finance hubs like Singapore, for instance, are broadly moving at the same speed in the same direction. I think it'll be more interesting to see how quickly the US catches up under the Biden administration. And also, of course, the other, the key country is China, the world's greatest, which is the world's largest emitter of greenhouse gases, and the extent to which their regulation, not just in banking and finance, but elsewhere, catches up.
Great, yeah. Simon, thank you very much. We're looking forward to keep working with you on mainstreaming ESG. Thank you, have a nice day.
Me too. Have a great rest of the conference, and hope to be with you in person in future years.
Thank you.
Bye, everybody.
Bye, Simon.